Welcome to BPP University's Enterprise Clinic's Guide to Starting a Business and an Overview of the Law. This is going to be a 4-part series which will touch on the following subjects: why start a business in the UK, different business structures, how to register a limited company, tax and regulatory issues, and online law. In this first section, we'll talk about why start a business in the UK and different business structures. So, in 2016, there were 5.4 million businesses operating. Of these, 5.3 million were micro businesses, which are termed as having 9 or fewer employees. What's more, there are approximately 50,000 businesses registered at Companies House every month. As you can see, the UK is popular for entrepreneurs for several reasons. Firstly, setting up a registered company can be cheap, from as little as £12. It's fast and can take less than an hour to register online, and the tax regime is cheaper, with corporation tax currently only 19% of profits. However, registering a company isn't the only way to run a business, and there are other choices open to you, with advantages and disadvantages to each. So today I'm going to talk a little bit about the different business structures. Now, these could be as a sole trader, a partnership, a limited company, or a limited liability partnership. There are other types which are focused at the not-for-profit sector, such as community interest companies, but I won't touch on those in this presentation. So when considering how to operate your business, let's start by exploring sole traders, which are by far the most simple format for a business. Essentially, a sole trader is the least regulated method of running a business, with usually just one person without employees. However, there is no distinction between you as a person and your business. In terms of advantages, it's cheap as there's no fees to register, it's very flexible, decisions can be made and acted on instantly, and it's inexpensive. All profits belong to you after income tax and national insurance contributions have been accounted for. Also, there is very little bureaucracy. There are no reports or accounts to file except self-assessment tax returns to HMRC. Finally, business expenses are tax deductible. However, there are disadvantages. The first being that it can be more difficult to sell your business on if you wish to. For instance, there are no shares in a sole trader company, and quite often the value is attached to you as a person rather than your business. Furthermore, if your business is very successful, tax can be higher than a limited liability company, as you'll be paying tax at the higher tax bracket. Finally, and most importantly, there's unlimited liability. Now, what this means is that you would have personal liability for the debts of your business, and this liability is unlimited, meaning that any business debt can be met from your own personal wealth, including any property that you own if the business fails. Next, let's have a look at partnerships. This is an agreement between 2 or more individuals to carry on a business as co-owners. It's not a separate entity to its owner, like limited liability companies. Each partner will have invested in the business and own a part of it. Income tax is paid by the partnership and profits and losses divided between the partners. Furthermore, each partner is registered as self-employed and puts in a separate tax return. Now, the advantages to a partnership can be similar to a sole trader. On top of that, you have the benefits of shared workload, so the business will continue if one person is sick and on holiday. And finally, the debts and responsibilities are also shared between partners. The disadvantages is that as well as the liabilities being shared, so are the profits. And also, there's probably a bit more paperwork involved, as we'd always recommend entering into a partnership agreement in advance. And this would talk about circumstances such as what would happen if a partner wanted to leave, how would the business be valued. If there isn't an agreement, the law will assume equal ownership and liability, which might not be advantageous if one partner's contributed more. Finally, and similarly to a sole trader, you have unlimited liability for both yours and your partner's actions. So thirdly, we've got a limited company. Now, this is essentially a legal entity all of its own that is registered at Companies House. It's easier to think of it as a firewall between your personal assets and the company's. This is because a limited company is a separate legal entity to the company directors, and therefore it's the business itself that shoulders the financial liability if the business goes under. As such, your home and personal finances are protected. Now, the business is owned by its shareholders, and liability is limited to the value of the shares held by those shareholders. So, for example, if the company had £101 shares that are issued to shareholders in the company and the company failed, the shareholders would only be liable for £100 of the company's debts. So the big benefit of limited companies is that there's limited liability for the debts of the business, and so there's less personal exposure to risk. Also, there might be perceived as being more credibility and access to easier funding if you're able to sell shares in return for funding the business. As a result of having shares in the business, it's easier to sell it on to third parties too. And finally, it's potentially cheaper tax regime than being a sole trader, particularly if there's more, the business is doing quite successfully. So, as we mentioned before, there's a 19% corporation tax, and directors can pay themselves through a mixture of salary, which is subject to income tax and national insurance, and dividends, which is subject to a 7.5 dividend tax. Now, as disadvantages, there's more administrative duties. So every year you would have to file statutory accounts to Companies House, which in the early years may not be that complex to complete. You'd also have to keep Companies House up to date with director and shareholders' details each year. Also, you'd need to file a company tax return to HMRC, and if you're paying employees, you would also have to account for employees' PAYE and national insurance contributions. Also, the company's directors have specific legal duties that they must adhere to. We'll discuss these duties in part 2. Finally, if the business becomes more successful and its accounts more complicated, it might be necessary to pay an accountant to prepare the annual statements. Finally, we'll talk about a limited liability partnership. Now, this is essentially a hybrid between limited liability companies and traditional partnerships. They offer the limited liability available to limited company shareholders, combined with the tax regime and flexibility available to partnerships. Usually, we would see limited liability partnerships in service industries such as solicitors and accountancy firms. Now, the advantages, like limited companies, are that it has limited liability and a separate legal identity, and so personal assets are protected. However, the disadvantages are because the individual partners are taxed as income, it may not be as efficient as a registered company, and there are the same reporting and accounting duties as a limited liability company. So in summary, in terms of the different business structures, you have the interplay between the flexibility and simplicity of being a sole trader or a partnership against the advantages of having a separate legal entity and protecting your assets that come with either setting up a limited company or a limited liability partnership. Now, in the next presentation, we'll talk about the most common business structure, which is a registered company, and we'll talk about how to register that company, the time frames, the costs, and also what information you'll need to have available before you do this. Thanks very much.